So tax withholdings, again, switching gears here. What are some of the top reasons why you'd want to review them? Well, at the end of the year. Well, let's say you got a second job, or you switch jobs, so your income changed significantly. Let's say you were unemployed for part of the year, and then you hopefully got a good job, and again, that will likely impact your taxes quite a bit. If you expect a large bonus, which is very common, actually, I work with a lot of my clients are attorneys, and for them, their incomes tend to be quite lumpy. So we usually talk about that at the end of the year in terms of how much should be withheld from your bonus. We talked about large capital gains or losses, and it goes in both directions. If you have large capital gains, you'd want to pay more in taxes. If you, for some reason, generated significant losses, then perhaps you would want to revisit so that you don't overpay. Now, one of the, I'm going to say most important here, because this happens almost every year, this situation, is when someone sells his or her house, they don't necessarily spend that much time to figure out their tax liability. And then comes the tax time, they send the documents to their CPA, they get their draft return back, they look at it and, oh, wow, I owe $20,000, $30,000, $40,000 in taxes. Again, it's interesting. It's such a preventable issue if you just sit down and spend half an hour, maybe an hour, figuring out what your capital gain situation would look like if you sell your home. But I mean, in my experience, most people don't do it up until it's too late, and then they're surprised when. And it's not just that you have to pay taxes; there are also penalties. So that's important too. So what are your options? So let's say, again, you've decided that you need to adjust your taxes. You have multiple options. You can adjust your withholdings or exemptions, I'm sorry. In my experience, that's one of the most challenging things to do, specifically at the end of the year, and I rarely suggest that. You can always add a flat dollar amount to your remaining paychecks. And I would say at this point, most people probably have 2 to 3 pay periods remaining. Now, perhaps the easiest option, and I know sometimes people don't think of it this way, is to keep your withholdings unchanged and then essentially make an additional, I'll call it an additional tax payment by January 15th for the fourth quarter. So that would be your fourth quarter tax payment. We do that quite frequently, especially when we deal with harvest and losses, when we review capital gains in our accounts, and when it's over, let's say what it was last year by a significant amount, just to be safe, sometimes I would say, okay, you know what, make a quarterly payment just to, again, eliminate any potential penalties. Now, in terms of eliminating penalties, I suggest that you become familiar with the so-called safe harbor rules. It can be really beneficial for you to, again, understand how it works. So the idea here is to really eliminate potential underpayment penalties. So to do that, you need to pay 90% of the tax you owe for the current year. So you need to estimate it and then pay 90%. The second option is to pay 100% of the tax you owed for the prior year. So I would say it's pretty simple for most people to look at their tax return and essentially pay the same amount. The only caveat here is if your income is above 150,000, you're actually required to pay 110% of your prior year tax liability. I'll tell you, in practice, when someone reaches out to me on December 20th and says, let's look at my tax situation, how much do I need to pay? I would almost always remind them about the safe harbor provision. We would estimate, would use option 2 or option 3, depending on their income, and just leave it at that, because it can be quite challenging to use option 1 if you don't have much time left. So managing itemized deductions, this can be really beneficial to some people. I'm going to say 1 out of 10, maybe 2 out of 10 at this point. And it's interesting, when I was looking at the stats post TCJA, essentially the Tax Act of 2019, only 14% of taxpayers itemized their deductions at this point. And the reason that's the case, well, you have limited control of your medical expenses. Let's say in most cases, real estate and local taxes are now limited to 10,000 essentially. And your mortgage interest, well, it is what it is. Usually you can't really control it that much. Now, you do have much more control over your charitable donations. So one of the strategies here, and again, this is something you would normally focus on closer to the end of the year, is to bunch your charitable donations into 1 year, or potentially create a donor advised fund. And I'll demonstrate what that means in a moment. So here's John and Judy here. So they have $10,000 of real estate and local taxes. Again, that's the limitation. $8,000 in mortgage interest. And they do have a significant charitable intent, so they donated $7,000 to different charities. So as a result of that, their total itemized deductions are $25,000. Well, the problem here is there's really no benefit for them in terms of the tax benefits of charitable donations, because the total is below the standard deduction. And in 2023, it's $27,700. So that's what's going to apply. So the fact, again, that they made charitable contributions gives them no benefit whatsoever. And again, I'm not saying they shouldn't be doing that. There needs to be that charitable intent. But I would say in many cases, people would also want to have at least some tax benefits when they do that. So here's Ted and Gloria. So they're in a very similar situation. $10,000 in real estate and local taxes, $8,000 in mortgage interest. So what they've decided to do, they've decided to contribute essentially 3 years worth of their charitable donations into a DAF, or so-called donor advised fund. And with DAFs, they're very easy to create at essentially any brokerage. It's just some paperwork. You make a contribution. You get a deduction in the year of contribution, which is what happened here, but then you decide exactly when and what charities will receive the funds in the future. Again, if you have that significant charitable intent, they can be really beneficial from both tax and actually practical perspectives. So in this case, their total itemized deductions turned out to be at $39,000. That is significantly above the standard deduction, so they will be itemizing. They'll be in that 14% of people who itemize, and in this case, I'll just give you a ballpark estimate. They're probably saving themselves $3,000 to $4,000 in this particular year. So again, can save you quite a bit of money. Tax efficient gifting. This is something again that people tend to think about closer to the end of the year, or gifting in general. So how do you make it more tax efficient? Well, I'll start by saying that cash gifts, they tend to be the least tax efficient in many cases, not necessarily in most, but I'm going to pass on those nuances at least today. Now, they're great and they're perfectly fine when you have many charities, or you're trying to gift relatively small amounts to many people, like your family members. Usually when someone comes to me and says, have 10 grandchildren, have some children, some grandchildren, I just want to give them some money, I would say, look, let's not complicate things, give them cash, see a smile on their face, and that's the end of it. Now, if you're thinking about gifting more, let's say we start talking in thousands here, well, consider appreciated stock. And again, I'll give you an example in just a moment of how it works. But it tends to be much more tax efficient, specifically when you deal with charities, because of course they don't pay any taxes. They don't really care what kind of asset you donate to them. And in terms of your family members, let's say your children or again grandchildren, if they are in a lower tax bracket, that can also be beneficial for the family as a whole. As a reminder here, the annual gift tax exclusion is $17,000 in 2023. They increased it to $18,000 in 2024. If you're gifting jointly, it's double of that amount essentially. And if you ever decide to gift more than that, it's usually not a big deal. You just need to file a Form 706 to record that additional gift over the annual gift exclusion, and it will reduce your lifetime exemption, which is what, over 12 million at this point. You just need to report it basically. So here's an example. So Mark here purchased stock X, Y, and Z for $500 share a long time ago. The current value of X, Y, and Z stock is $1,000 per share. So it really appreciated in value over the past number of years. So instead of selling the stock and gifting cash to the charity of his choice, he decided to give the actual stock to the charity. And by the way, it's very simple. Well, you need to complete a couple of forms, but the vast majority of charities, especially national ones, they make it very easy for you to do so. So as a result of this approach, well, he receives the $1,000 deduction for his contribution, and he also eliminates potential taxes or capital gain taxes on $500, which is the appreciation on this position. And of course, in this example, we're talking about $500, but imagine if someone wants to gift sometimes tens of thousands year over year. I mean, this can really add up to a lot of tax savings. Required minimum distributions. So if you're reaching your 73rd birthday, anytime soon, this is something that you should certainly be thinking about. So again, under the Secure Act 2.0, the new RMD age is 73, and over the next number of years, I don't remember exactly, it will actually be increased to 75, but at this point it is 73. So your very first distribution, your very first RMD will be based on your life expectancy. Usually for the first year, I would estimate it at a little below 4% of your, again, IRA, 401k, or any other pre-tax account. Now, almost again every year, at least on my end, when I work with newer clients specifically, if you ever inherited an IRA account, over the past what would that be, 4 years or prior to 2019, make sure you review if you need to take any RMD out. So under the new rules, there's this 10-year provision. Essentially, you have a choice. You can either take some funds out each year, if that's what you want to do, or you can wait all the way to year 10 and take the entire amount out in the form of your RMD. So I've done calculations for some people to figure out what works best for them, and there's no clear answer. It really depends on your specific circumstances. One thing I will say, the IRS provisions on the 10-year rule, they're not really clear at this point. Something I've been paying attention to, because as we speak today, again, there's that option of delaying to year 10, but perhaps it will change at some point in the future. At least there's some talk about it. Finally, of course, don't miss your RMD. There's a 25% penalty if that happens. Again, under the Secure Act 2.0, they reduced it to 10% if you fix the issue within the correction window, which is by the next tax season, essentially. So you have essentially a year and a half to do it. Again, in practice, when people forget about it, usually it happens for years, and then 5 years down the road, it's like, oh wow, I should have taken it over the past 5 years. Now you have to fix it. It's a headache. So the bottom line is, don't miss your RMD. All right, so here's the 11th idea. So what's the best way to start 2024? And again, when I was preparing for this webinar, I had more ideas than that, but I thought I would condense it to a manageable number, which is 5. So the first one is, of course, review and update your financial goals. And I'm biased here. I'm a financial planner. I believe that everyone should have a plan in place. There's absolutely nothing wrong with having a one-page financial plan when you have your goals and objectives, and you have at least some details in terms of how you're going to accomplish that, but there needs to be a written plan in place. When people keep it in their head, there's a much lower probability of them actually doing anything about it. So year over year, they have all those ideas, New Year resolutions, and nothing really happens. Now, consider establishing a reasonable cash reserve fund. And there's a reason why I underline the word reasonable. So usually, 3 to 6 months of your regular expenses is how much you need to keep in reserves. So if you spend $5,000 a month, it would be anywhere between $15,000 to $30,000. That's how much you would keep in reserves. Now, every so often people reach out to me and they have essentially nothing. They have their savings, they have their investments, IRA accounts, but there are no reserves. So if they ever lose their job, especially when they're single, chances are they'll be in trouble, or vice versa. They accumulate a lot of cash, let's say $100,000, and that's great. That gives you a great safety net, but a lot of money is essentially not working for you. And that leads to the third point. There's this, idea that you essentially wait until the end of the year. I can't really explain why so many people do that, to contribute into your IRA, max out your HSA contributions, 529 plans, again, everything we discussed today. But there's no reason for you to wait. If you have the money, if you have the cash flow, and you want to max out those contributions in January, absolutely, that would be a great idea, because essentially the funds inside of those accounts, they'll be working for you for an extra year, right? If you contribute in January versus November or December. Be careful with your 401k contributions though, because if you get an employer match, you would need to contribute, I'm going to say, somewhat evenly throughout the year. Automate as much as possible. So in terms of some of the financial plans that will be implemented, usually the fact that they're automated is one of those deciding factors. So, if people start marking their calendar to do certain things, that's fine. But if it's automatic, chances are, the success rates of that plan will be significantly higher. And then finally, this what really works well for many people, or doesn't work at all, it depends, but still consider that, the idea of paying yourself first. So what happens in many cases, people have their income, they have their budget, and they spend, or they save, I should say, what remains after they're spending. Try to do the opposite. Figure out how much you want to spend in 2024 and make it automatic. So anytime you get a paycheck, X dollars goes in your 401k, Y dollars goes into your IRA account, and Z dollars goes into your 529 plan, and then spend the rest. See, for some people, this approach is not going to be comfortable. It's like, oh, wow, exactly how would I manage this? But at the same time, in terms of your overall plan, can be very effective, because again, it happens automatically and you're paying yourself first. So again, I had so many situations when people struggle with budgeting, and then by paying yourself first, it really keeps them on track. All right, so we are at 12:50. If you have any questions, please type them in the chat box and we will address them. We have 4 questions actually from the participants prior to this webinar, and I will address, I guess, a couple of them just to make sure we finish on time. So the first one says, best options for yield in today's market environment. Well, that's actually a really good question. We certainly have many more options today versus where we were, I'm going to say, pre-pandemic. So I'll mention 3 options. There's certainly more than 3, but I'll mention 3. Treasury bonds. That's perhaps one of the best choices, especially for those people who are, more risk averse. At this point, bonds with maturities of less than 1 year pay more than 5%. But keep in mind, again, once they mature, you don't really know what the yields are going to look like. If you're focusing on bonds with maturities of, let's say, 1 to 5 years, plus or minus, you're looking at yields at right around 5%, usually a bit below that. But at the same time, you're locked in at those rates. Dividend paying stocks. It's interesting, again, I cannot give any specific examples, but many of them are actually in the negative this year. And I know it's strange to say, especially if you paid attention to the latest rally that we experienced over the past couple of days. But they're healthy companies. They have yields of 3, 4, maybe 4 to 5%. And again, these are stocks. There's always that growth potential. And then the third choice, which is certainly not for everyone, but we have it on our end, we include it in some of our more income-oriented portfolios, are high-yield bonds. So high-yield bonds or below investment-grade bonds, or sometimes people refer to them as junk bonds. They currently pay more than 7% as a category. Depending on what you're looking at, it would be 6 to 8. But again, that's quite attractive, at least for some with inflation at a little over 3% at this point. There are some more exotic options, but I will pass on those. And the second one, which I think I covered it, but I will read it, which I thought it was a really good question. So how to prioritize investing? So more of a basic question. So my answer would be, well, of course, that depends on your specific circumstances. What are you investing for? Are you trying to save for a down payment, or is this more for general retirement purposes? But in general, I would start with your 401k. It's usually very beneficial for you to maximize your 401k contributions. One thing I believe I neglected to mention earlier, so there's no income limitations. So like, let's say with a traditional 401k, if you're making $500,000 a year, you would still qualify for pre-tax contributions. So doesn't really matter what your income is in terms of qualifying. Then maximize your IRA contribution, Roth versus traditional. And as I mentioned earlier, Roth would probably be my preference. HSA accounts, if you have access to them, max them out, especially if it's a family plan, $7,700. If you have children or potentially want to help out your grandchildren, consider 529 plans. Again, they're a great option, specifically in the long run. And again, once you maximize those 3 or 4, again, depending on your circumstances, I would focus on more general investing, essentially in your brokerage account. We have a couple more, but I don't think they're necessarily related to this webinar. So if you ask those questions, feel free to reach out. I'll address them separately. And with that, again, we have other future events for those of you who are interested. Actually, tomorrow there's going to be one in person for those of you who live in our area. It's called The Truth About Getting Your Affairs in Order, and I will be co-presenting with an estate planning attorney on different issues, usually relates to people in their post-retirement years. Later this year, we're actually going to have a very interesting webinar we're working on, also with an estate planning attorney, but it's in a different subject in terms of how to create wealth for generations. So we're going to be focusing on multi-generational wealth creation. And then in terms of our webinars here at CSF, the next one is our quarterly market update. Every quarter at the end of the first month, essentially we update everyone on the markets and then share some of our top strategies. So again, if you're interested, please visit our website to check it out. So yeah, we're 12:56, perfect time. Again, thanks everyone for joining us today here through Microsoft Teams and also through LinkedIn. Of course, feel free to reach out if you have any questions. If you're interested in a complimentary strategy meeting, please reach out. Here's my email address. Here's my Calendly link if you want to schedule it directly. Everyone will receive the video recording. Give us a couple of days to process it, and the slides, hopefully by Friday. So again, thanks so much, everyone, and enjoy the rest of the day.